we are not paying enough attention to this in my mind. This idea that risk is being played out in high yield as well. I just want to look at this because over the last month, that high yield fund has now taken a move to the downside, as you can suspect. But what exactly is driving a lot of that action?
Well, first, of course, is the virus risk. But in the recent days, it's liquidity risk. We're probably in a liquidity recession right now.
So explain that to us, because Anastasia on set brought up the liquidity as well. It is because these types of bonds aren't as easy to trade, say, as Microsoft stock, right?
That's right. You have intense selling pressure in the ETF space, but the bonds, the underlying bonds, are not as liquid. So it's creating an air pocket in terms of the price of these bonds.
All right, so here's an interesting chart. Investment grade versus high yield, return-wise. If you look over the last 10 years, right, high yield is actually doing pretty darn well, outperforming treasuries, investment grade. It's getting a little bit more even here since 2014. And since 2018, September of then, it really has been investment grade. That's the real standout, and high yield as the real underperformer. Explain to us that divergence. Why are people so much more enamored with investment grade these days than high yield?
Sure, treasuries are the dominant factor here, and government bond yields are at record lows, and that's why investment-grade bonds have continued to generate returns this year, while high yield has gone negative over the last few days.
So there has been a divergence developing in the marketplace as of the last couple of weeks, where investment-grade debt has been performing so much better than junk-rated debt. And you can see here kind of like the moves, double B being junk, triple B being more investment grade. Talk about the divergences that you see. Is this enough right now to signal that a bad time could be ahead for the overall market, given the dynamic in junk bonds and investment grade?
Well, clearly the risks of recession are growing quite a bit this week. For a long time over the last 3 years, triple Bs were very attractive relative to double Bs. But just in the last day or two, double Bs are starting to look more reasonably priced compared to triple Bs. So there's core bonds are still very important in an environment like this, but investment-grade corporate bonds might start to act more like high-yield bonds from this point forward, because the Treasury effect is largely in it. Now you're going to deal with the spread widening.
All right.